Hello there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, investors, authors, educators, traders, money manager, and learn from their experiences navigating the market environment. We love to ask about process, about routines, about mindset, about lessons learned through their successful careers and applying their tools and techniques to the current market environment. Great conversation to share with you today with George Noble. George is a longtime fund manager, hedge fund manager. He was an intern for Peter Lynch back in the early 1980s at Fidelity. He ended up running the first international fund for Fidelity Management and Research in Boston, the Fidelity Overseas Fund, which ended up having absolutely exceptional performance right out of the gates. And my conversation with George asked him about that period, about lessons learned from working directly with Peter Lynch. And he also worked with some incredible other legendary Fidelity investors like George Vander Heyden, Bruce Johnstone, and others. And I tried as much as I could to tease out some great anecdotes and lessons learned from that period. We also talked about some of his challenging experiences, lessons learned from periods of bad performance. The struggles after the overseas fund in the early 1980s, mid 1980s had incredible success. What happened when we got to the 1987 crash and how he sort of was able to navigate through that particular period. We talked about more current market environments as well. And I think through the course of that discussion, you'll learn a little bit about George's balance between the micro, analyzing companies and particular opportunities, versus the macro. And as an international fund manager, as he will explain, you have to understand the macro because currency differentials matter. Interest rates matter because it's impacting your portfolio where you're buying assets in other currencies and then have to convert them back to US dollars for your fund. He recently did his first investment conference. It's called the George Noble Investment Conference, and he very kindly shared some of the key takeaways, talking about market liquidity, talking about gold and precious metals, talking about Bitcoin and other cryptocurrencies, talking about some of the challenges in 2025 with tariffs and so many other uncertainties. A wide-ranging conversation. I hope just scratching the surface of what we can do with discussions with George. So I hope this is the first of a number of interviews we can do on the Market Misbehavior podcast. But for now, I ask you to enjoy this great conversation with legendary investor George Noble. Sitting down with legendary investor George Noble. Super excited, George, to chat with you. I don't know if you remember, but we first met at one of those chart dinners in Boston. It was years ago, and I didn't know you very well, and I sat next to you, and I remember afterwards asking one of my analysts, Mark Dibble, I'm like, who's the guy next to me? Because he was fascinating. He's like, it's George Noble. I was like, oh, all right, we should hang more. So it's so fun to be able to chat with you now. Welcome to the show.
Thanks, Dave. I'm a big fan. I watch your show regularly.
No, I appreciate it. So a lot to talk about. I feel like we're not going to have nearly enough time to talk about all the things I'd like to, but I hope this is the first of a number of conversations we can have, George. To start off with, I mean, you've had a pretty remarkable career in the financial industry, starting at Fidelity, early 1980s. I want to say like 1981, 80 or something.
Yes, I was a summer intern in 1980.
Right.
And to show you how times have changed, when I first got there, Fidelity was only managing, I think, $8 billion. Now it's about $6 trillion.
Yeah.
Only managing $8 billion.
Wow.
And the way it worked was I had 2 summer interns every year, and if each intern came back, there was one from Wharton, one from Harvard. There was no room to hire anybody else. And so I went to work at Fidelity. I took less money than I could have gotten elsewhere in other verticals. And it was like, why are you doing that? And I was like a stock nerd because from a young age, my dad was a mathematician and I love numbers.
Yeah.
And there was this thing called Fidelity Management and Research. It wasn't Fidelity Investments.
Yeah.
And Peter Lynch was kind of like emerging, but I mean, talk about being in the right place at the right time. I mean, the Dow Jones was at 800. It was August of 1981 when I went to work there permanently. And Bruce Johnstone, who you remember, he was predicting the Dow's going to go to 5,000, and we're all looking like he's crazy. Like, what are you thinking? Okay, and so David, you've heard the phrase before many a time. Never confuse brains with a bull market. Okay, so listen. I like to think I work hard. I'm not stupid. But there's also an element to being in the right place at the right time. You should never forget that. You should never
You
forget that.
certainly seem to have played that. I mean, probably one of your best trades, I would say, ever being at that point. So as you and we're going to talk about the current market environment for sure. We'll get there eventually, but when you think about those formative days when you're actually just getting your feet under you as an investor, any kind of early lessons learned that you find you still refer back to today when you're analyzing the markets?
Yeah. I think it's probably true in most endeavors. Try to find someone you can emulate.
Mm,
Find a great and imitate. And, I've got numerous character faults. But one of them is someone once said, I can't remember who it was, God gave you one mouth and two ears. There's a reason for it, okay? And when you're sitting there in the conference room at 82 Devonshire and Peter Lynch or George Van Hyden or Bruce Johnson's asking the questions, you young, impudent whippersnapper, keep your mouth shut and listen. All right. So I was fortunate to have, they always say stand on the shoulders of giants. I was
mm,
fortunate. I didn't realize how fortunate I was to be in the company of such investment prowess. But so one, listen. Humility comes with it as well.
mm.
Um, David, how do you define experience? I think it's what you make. I forget the line, but you make it. Your some of your mistakes is wisdom or whatever. Okay, and like my father always used to say, there's two ways you can learn things, either by precept from a book
Yeah.
or by experience. And it's much more economical to learn by precept, but we're all human, and we all have to make the mistakes ourselves. So Mr. Market teaches you humility. I've gotten my head blown in more times than I can remember. It's embarrassing when I look back on it, but it's not an easy game,
Yeah.
and it's not an IQ contest either. You know that, okay?
Mm.
It's remember the old Ned Davis line, David? Would you rather be right or you want to make money?
Yeah.
Okay,
Yeah.
it's and you know this. Some of the best clients you've had, some of the smartest managers of Fidelity, it wasn't because they could run a spreadsheet better than somebody else.
Yeah.
Maybe it's someone like Jeff Finnick who's got a better
Mm.
feel or can smell the shorts getting squeezed or whatever. Okay, so I can't remember who said it, but I agree with it. I think if you're an expert in psychology, if you had a PhD in psychology, that may get you a lot further than studying accounting. I mean, but the main thing is you got to have all of it. Okay, and
Yeah.
you may remember the book. I'm talking too much, David, but I'm reliably informed. I do talk too much. Um, the Dow Jones average by Bennett Goodspeed. Okay,
Ooh.
okay, you remember that one? Okay,
For
and so they
sure.
talk.
Yeah.
Okay, then you maybe another episode we can talk about it. You can explain your viewers or offer a free copy. I don't know if they even make it anymore, but he was basically talking about some are left brain dominant, very analytical,
Yeah.
quantitative, et cetera, and then you have the creative, artistic, right brain dominant folks. But the real key to being a successful investor is pursuing a whole brain approach to investing. And I will tell you, to this day, I still haven't mastered that. It's a constant struggle, but it's and there's and as you'll remember, I think it was not Ned Johnson, but Mr. Johnson came up with a line about how the market is like a mysterious, beautiful woman, always changing, and you can't quite figure it out. And my line to that is, just when you think you got the rules of engagement figured out, they change them on you,
Yeah.
right?
Yeah.
So, I mean, and again, I think it was a Walter Deemer quote actually, where he said something. And I'll send it to you. You know the quote, but something like, the markets. And maybe it wasn't Walter Deemer who was borrowing from somebody else, but the markets humbled more people than like anybody
Yeah.
in the history of mankind. I mean, it's not easy. It's not.
Yeah.
It's
Yeah.
not.
That Goodspeed book, the Dow Jones averages, I refer people to that often, and very few people have heard of it. But I mean, it's an easy read, but it's
Yep.
brilliant, and it talks about balancing, analyzing the veins on an individual leaf, which is what you're doing, digging into a company versus looking at the tree, the branch, and the forest, and connecting those two. And I think we've
Hmm.
both seen people who struggle to make that jump from analyzing, the micro to being a money manager. We have to think about tides and shifts that are much bigger than individual companies.
100%.
Can you talk a little bit? I mean, you were the first international portfolio manager at Fidelity, ran the Fidelity Overseas Fund at a time. I mean, now the global operations of Fidelity are pretty huge, but at the time, this was sort of new territory for Fidelity to go into, and you're working with a number of portfolio managers who are not focusing primarily on non-U.S. markets. What was that like, and any sort of early missteps that were, you mentioned humility. What were some humbling experiences that helped you grow as an investor trying to manage non-U.S. funds?
Well, by way of clarification, so Fidelity had a sister company, Fidelity International,
That's right.
which had offices in London and in Tokyo.
Yep.
And they were having tough times. And while the Johnson family owned both, they ran as a separate company.
Mm-hmm.
And so we would have visits, and I'm sure you remember some of the folks like Anthony Bolton and
Yeah.
Simon Frazier and whatever come
Yeah.
over. And I'd go to London or Tokyo, and I'd meet with them. But, it was almost as much as a rivalry as anything. A healthy competition. And so I learned early on that I had to pay attention to macro.
Mm.
As much as Peter would always talk about, he spends 5 minutes a year thinking about the market and the rest of the time picking stocks. Listen, if you own a yen-denominated security, no matter how well the stock's doing, if the yen's tanking, you got a problem.
Right.
And ditto, you could have a mediocre British stock, but if the pound sterling is going up, you could do really well.
Yeah.
And the macro cycles, the macro environment, each of these countries is very different. So international diversification was the thing, because in some countries, you might be in the early part of the profit cycle, and liquidity conditions are improving, and so it's easy sailing. The wind's at your back. You could find other countries, though, where maybe the economy is overheating, they're having to raise rates, profits are peaking, not so easy. So, I first got dispatched to look at foreign stocks in early part of '84. It's so funny.
Wow.
And this is all Peter Lynch, the brilliance of Peter Lynch.
Yeah.
You can go back to One Up on Wall Street, whatever. I think I've actually mentioned the book a couple of times. At any rate, I was the third research assistant for Peter, preceded by Rich Fenton, who I remember,
Yeah.
and Danny Frank.
Right.
And Peter started to experiment. We had a few foreign brokers came along, and then they're recommending Volvo or Astra or Scandia, or it's a funniest story. To the Spanish phone company in a second. You got to ask me about that. But anyway, Peter got interested in foreign stocks, and Peter has this, just infectious curiosity.
Yeah.
And he'd hear these stories, look at the growth rate, look at the valuation. God, this is great, And so I was like, by the way, talk about being lucky. Holy smokes! I forgot to tell you, before they put me on the overseas fund, they started me off in the fall of '81. They made me the domestic retail analyst. I don't remember Barry Greenfield, who was director of research.
Okay.
God rest his soul. So they made me the retail and auto analyst.
Right.
They gave it. That's for the beginner guy, the idiot guy. Paul Stuka got emerging energy stocks, wherever it was. Right. And so, guess who got to carry Peter Lynch's bags when he went to Detroit to have all day at Chrysler with Lee Iacocca? And then we went to Ford, and we went to GM. Chrysler was given up for dead.
Right.
I was the auto analyst. I had nothing to do with it. I just carried his bags. But I didn't know that history was in the making, but I knew to shut up. And I can remember it like it was yesterday, sitting there with, Iacocca and Bob Lutz and all these guys. And the street hated Chrysler, and Peter just bought the daylights out of it. All right.
Right.
So I started off. I was the retail analyst, the auto analyst, and then in '84 they wanted to do foreign stocks. Peter's like, "Okay, George, I want to do foreign stocks here. Go figure it out." All right. And I did that for a few months, and then the second half of '84 they said, "Hey, we want to do a foreign stock fund. Noble, you're it." Okay. So good luck. And actually, it was a curse, David. I'll tell you why. Because I was so lucky. Yeah, I worked up, but I was so lucky. I started running money December 1st of 1984. I was the first to manage the overseas fund. Paul Stuka was the first fund manager on the Fidelity OTC fund.
Yeah.
This is like something out of the storybook. Those two funds, you could look it up, is as Casey Stengel, Yogi Berra once said, in 1985, the first year of full operation, those two funds were number one and number two, respectively, in the entire country.
Wow.
The Fidelity Overseas Fund was up 79% in 1985. It was up 69% in 1986. And in 1987, before the crash, it was up 59%. But then we'll get to my big mistake.
Right.
So in any event, the curse of being so successful coming out the gate, it was actually a real curse for me because I felt such pressure. It's sort of like, instead of just getting your bat on the ball, if you get up there trying to hit the ball out of Yankee Stadium every time, you get a strike out, right?
Yeah.
So I was pressing, and that eventually caused problems for me. It caught up to me. So, I think a left brain dominant, type A, hyperactive Jewish kid from New Jersey maybe is not the best personality for running a mutual fund. Okay, better to have a more laid back guy like George Vanderheiden.
Right.
Okay, because all right, okay. See, so unlike the ABC Wild World of Sports commercials, you remember from way back when the lead in, the thrill of victory, out any defeat. Okay, better you want like a softer sine wave. Okay, so anyway,
Right.
so I was going for it, and the getting was good.
Yeah.
But 1988, not so much. So what happens? 88 rolls around. So 87, sorry, 87 rolls around.
Yep.
And I remember the summer of 87. I don't want to say it's reminiscent of now because it's never the same, but
Okay.
markets rhyme.
Sure.
And I remember it being at the Delaware Shore in 1987, in August of 1987. And interest rates have been going up, inflation was going up, and I'm like, this isn't going to end well. And I'm like, George, this has all been a mirage. It's been a dream. You're a fraud. This is all make believe, right? And then the crash came.
Right.
I remember exactly where I was when it happened. And I'm like, now we're back to reality. This is like, there's got to be the puritanical revenge of the system, right? We got to pay for our sins. And so what happened? This is my big mistake. You didn't ask me, but I'm going to tell you.
Yeah, do it.
I'm like, I'm convinced the world's coming to an end.
Okay.
Okay. The world will usually not a good bet, and it's only going to pay off once. Okay.
That's right.
The history of mankind is that bet never pays. Okay. So what happens after the crash? All right. Like I was getting the yin yang redeemed out of me. All right. I mean, this fund went from like nothing in December of '84. It peaked at over $3 billion. All right. Magellan was only 5 at the time. That's a big, relative numbers. All right.
No.
And I'm getting redeemed $100 million a day on a $3 billion fund.
Oh.
It gets better.
Okay.
So foreign stocks, you wouldn't know this detail. So you get more than you bargained for. You wouldn't know this detail, but foreign stocks, they had a different settlement period than U.S. stocks. In some cases, they take a week, 2 weeks, or in Italy, it would settle once a month. And so what would happen? Brown Brothers was the custodian of the fund. You can't make this stuff up. And so, Fidelity's having redeem whatever. I think it was 3-day settlement back there, or 5. I can't even remember. It's not 1 day anymore. It wasn't 1 day. Look at it now. And so people are redeeming. They got to pay them the money out. But even if I was selling stocks quickly enough, it didn't matter because Italy wouldn't get the money till the end of the month anyway.
Yeah.
So I had George Sullivan, who's like the CFO, coming around, the treasurer. He'd be like, sell more. Ned's getting all panicked because they're having to borrow a bigger and bigger credit line from Brown Brothers. And I'm like, dude, I'm selling as fast as I can. And it got so bad. I was overselling, trying to anticipate the redemptions that were coming the next day. This thing about buy and hold and the passive bid, trust me, that did not exist back then. All right. So anyway, let me stop. So David, is there a question?
I love that. Oh no, there's so many great points in there. And you hit toward the end, and a number of times along the way there, just talking about some of those early experiences. The behavioral challenges, right? The emotional challenges of what we have to do. What words of wisdom do you have for people trying to manage, especially 2025? I feel like it's just one of the more uncertain, volatile periods that we've experienced. How do you manage the emotional side of things? How do you stay centered when it feels like, at times like that, when the world's like going in flames around you?
Good friend of mine told me years ago, and he's right. He's like, you got to fade your own emotions. So, when you want to throw up, you should double up. Okay, but when you think you're a genius,
I
it's
love
like,
that.
look, ma, no hands, I can do this, right? What me word, Alfred? Please call your office, all right? Okay, it's like no, David. It's like you talk about when you're eating, you should eat to the point where you're not hungry,
Mm,
as opposed to eating to the point where you're full,
sure.
because there's like a 20. Okay, so when you get the feeling of satiation, like this is really good. My inclination has been historical. One of my biggest mistakes. It's like I want more and more
Yeah.
and more. Like you can't have enough, right? Give me another glass of wine. I don't do drugs, but I love good wine. All right. But when you get to that point, it's like you got to know yourself and say, wait a second, okay? Or when it's really bad, this too shall pass.
Yeah.
And to borrow the line from Pogo, I met the enemy, and it's me. I am my own worst enemy. And I can't remember, David. Was it Sir Edmund Hillary or whatever? It's like made a similar quote about conquering oneself.
Yeah.
Same problem. And what's really difficult right now, and you know this because you're a market historian. You look at long term charts. What we've been through post GFC is not normal.
Yeah.
It's not. I had the conference last week. Michael Howell, brilliant liquidity guy, called him liquidity king. I coined that phrase, and it used to be the bond king, Bill Gross. It's always about liquidity now. He points out, he goes, you read Sidney Homer, The History of Interest Rates, 5,000 years going back, 0% interest rates are not a thing.
Right.
Okay, but we've gone through this last post GFC era where, I mean, you had negative interest mortgages in Europe at one point. Right, this
Yeah.
is crazy.
Yeah.
So when you have bond yields down to 1%, and that's supposed to be the risk-free asset, and the misallocation of capital that occurs therein, and then people start to think, well, 50 times earnings, okay. No, it's not okay. All right. And one of the biggest concerns I have about the market right now is interest rates and bond yields. We'll get to that in a couple of minutes.
Yeah.
So what we're going through, though, is we've come through a whole period. It's not normal. And it's the recency bias. This is what a lot of investors are used to, especially those who came into the market post-COVID.
Yeah.
And again, by way of reference, hard to believe, this is true. When I joined Fidelity in 1981, this is shocking. This is in the 1970s. They had just come through a period in the 1970s. They actually lost money, Fidelity did, for a couple of years. They had layoffs.
Oof.
Okay, because you'll remember, you go back and you look at the history books. You had the Nifty 50 and the bull market.
Sure.
I can't remember what year it peaked, and then you went through a decade where stocks went nowhere. That's in nominal terms,
Yeah.
because we had inflation. In real terms, it
Real
was a
terms,
huge bear market.
brutal.
Okay,
Yeah.
and little stocks got killed.
Yeah.
Peter would always tell the story about buying Taco Bell and one times earnings, all this craziness. All right, so investors today have a different challenge, and that is we've been through a period that's not normal, and we've had this sort of liquidity, the champagne liquidity kept flowing, and money keeps going. Markets keep going up and up and up. They've inflated everything. It's not just stocks. They inflated the price of bonds, but that's coming undone. They inflated the price of houses. That's starting to get undone.
Yeah.
They inflated the price of stocks. And my crystal ball's not better than anybody else's. I'm just saying. And David, I'll ask you. Let me ask you this question. I'll turn it around on you.
Yeah.
You look at what you're seeing happen in the last year or so, whether it's the fourth consecutive year of declining bond prices, or it's the dollar now going down, or it's the U.S. starting to underperform ACWI.
Mm.
The gold price going up despite the fact that interest rates are going up. I mean, you see some changes happening from what we were seeing the prior few years?
I mean, undoubtedly, right? And I always talk about, in my work, I always talk about a change of character, right? Where the market has a certain character, certain
Mm-hmm.
configuration, and then something's different. And I mean, maybe liquidity is the biggest thing, right? I mean, and I wonder what the charts would look like over the last 3 to 5 years without the amount of liquidity that we saw. And I think it would not be as good, right? That's just kind of right.
You triggered me in two ways.
Okay.
One, I'm going to say, you talked before about things changing, character
Yeah.
change.
Yeah.
So I go back to like 22 or 23, and interest rates started going up at an accelerated pace. Okay, and I said, "Whoa, the dollar's strong, and interest rates are going up. The price of gold must go down. It always goes down when that happens."
Right.
Okay, And I was wrong for a few months. I'm like, oh, the market's wrong. No, the market was sending a message,
Yeah.
but no one. But I didn't get the memo right. And most people didn't get the memo initially. But then I got the memo,
Yeah.
and that's also extremely relevant what's happening right now. So it goes back to what I said before. Just when you think you got the rules of engagement figured out, they change them on you. All right,
Yeah.
and so it's uh, it's not easy. That's all I can say.
You
And
mentioned
it's
the conference that you did last week, George, the George Noble Investment Conference. I hope the first of many that you did, because it was a pretty powerful lineup of independent research providers. You mentioned, I think Michael Howell was one of the speakers there. What kind of key takeaways as you went through, hearing from some top strategists, what kind of takeaways stood out to you?
So I don't want to give all the cards
For
away.
sure,
And
for
David,
sure.
I think we're probably going to do another conference worth along. This one's going to be more stock picking oriented,
Oh, nice.
we had John Roque as the technician. We'll get you next time to talk about the charts. But
Yeah.
I don't want to give everything away, but I will say a couple things that really blew me out of the water. I mentioned the sovereign wealth fund thing. If that happens, that could be a huge deal.
Yeah, and tell me more about
Um,
that. We weren't on the recording yet.
yeah.
When you mentioned that, tell me again
Okay.
what that involves.
So Ian Harnett of Absolute Strategy Research,
Yeah.
the number one European independent research firm, was pointing out about some of the declarations that Scott Bessent and the administration made earlier in the year. They're talking about possibly establishing a sovereign wealth fund for the United States. And I was like, when I first heard, that's crazy. What are you talking about? Saudi Arabia has a sovereign wealth fund because they got a lot of revenues from the oil production, as does
Sure.
Norway. But what do we got? All we do is produce debts. Like, what are we going to do? Okay. So I'm like, this makes no sense. This
Yeah.
makes as much sense as Trump coming out with a shitcoin, okay, which he did. All right, okay, whatever. All right. So Ian though was talking basically, look at the fine print. Apparently, I guess they were starting to talk about this already under the Biden administration. It's not a Democrat or a Republican thing.
Hmm.
About possibly taking, I think the U.S. rough back of the envelope calculation, the U.S. owns about $200 trillion worth of assets. 200 trillion.
Right.
The land, the parks, the whole deal. And putting that on the balance sheet and then maybe privatizing some of that stuff and sell off a small piece of it at a big discount to intrinsic value and make it so that the individual investor can buy a piece of it. So like a privatization you had in many European countries going back 20, 30
Yeah.
years ago. And those were very successful. And if that were to happen, people would look at the U.S. government and say, unlike a company, okay, imagine you have a company which has revenues of 5 trillion, but is spending 7 trillion. They're losing 2 trillion a year,
Yeah.
and they owe the banks 37 trillion. And on top of that, there's 100 trillion of off-balance sheet liabilities. So you'd say, oh, you want to borrow more money? For you, special rate, okay, junk rates, right? Okay, and that's kind of what's happening with the U.S. long bond right now.
Yep.
But if all of a sudden the guy says, "Yeah, we're losing 2 trillion a year, and we owe the banks, 37 trillion, and there's 100 trillion of contingent liabilities," on top of that, though, guess what? I have here in my hand. We have a deed. We have this asset's worth 200 trillion. You'd be like,
Hmm.
hmm.
Yeah.
So this collateralized, right? So
Yeah.
Ian was talking about the possibility of a sovereign wealth fund. That was mind-boggling.
Wow.
Another key point, and this is from Jay Pulaski, who was formerly the emerging market strategist at Morgan Stanley, now runs TPW Advisory, his own independent research firm.
Yeah.
Tavi Costa out of Crescott Capital in Denver. His gold fund's up 89% this year. Michael Howell, as I mentioned earlier. The thing that came through, and I don't want people to say, oh, it's an echo chamber, it must be wrong. No, it's an echo chamber from the smartest guys in the business, okay?
Sure.
This is not consensus. This may be consensus of the guys I had because I selected my own echo chamber. But the thing that was very clear, and they all said it a different way, and I'll just seize on Michael Howell. He said the U.S. may win the trade war, but it's going to lose the capital war. It's losing the capital war. In other words, we've weaponized capital.
Yeah.
And to the extent that we run huge deficits, we buy all their stuff. In return, we sell them financial assets. So if we start putting tariffs in, and so therefore it's effectively a tax increase, all right? The price of all the foreign stuff goes up. We buy less of it. We buy less of their stuff. They should have to ship us less money to buy our financial assets, which means there's not as much foreign support for U.S. equities, U.S. stocks. So if you see the trade deficit come down, which everyone thinks is good because we're going to onshore and all this kind of stuff, be careful what you wish for. That may not be so good for stocks and bonds. And so what really resonated with me is we've reached the limits, I believe, of, uh, of fiscal profligacy.
Yeah.
The new administration came in with promises of deregulation, tax cuts, austerity. I said from day one, on November 6th, day after the election, I said this is not going to work. Okay, and as my good friend Stavros Atreides said, he also presented from Investment Research. DOGE is DEAD. Okay, Doge was never a thing. Okay, I mean when you look at the numbers, David, it's insanity. Okay, I
Yeah.
mean the budget. 85% of the budget is non-discretionary. It's either interest or entitlements or defense spending. You only got like $1 trillion worth of discretionary spending.
Yeah.
You're talking about cutting $2 trillion, then $1 trillion. They'll be lucky if they do 50 billion. So the point of it all is, you know, they keep spending and spending and spending, and a lot of this has been financed by foreign buyers. The bond market. And as the saying goes, never depend on the kindness of strangers. And so you're seeing interest rates ratchet up. So if you said to me, but you didn't ask me, I'm going to tell you anyway. If you said to me, George, what are you worried about? All right, for me, if you said make up a bearish scenario,
Yeah.
it's going to be that interest rates, long bond yields, are going to go up more quickly and more significantly than people imagine.
Mm.
So, and I'm not saying Weimar levels. Let's say I had, December 31st Wall Street Journal, David, this year, and I told you with perfect foresight, for long bonds, 5.5 or 6%. For $50 in double jeopardy, is that good or bad for the stock market? Okay. So my problem is that there's no constituency really. There's no stomach for cutting spending in Washington.
No.
It's not a Democrat thing or a Republican thing. All right. And they're just going to keep doing more and more and more until Bond, not James Bond, but the long bond
Yeah.
puts an end to this. Okay. And I'll stop with one other. I collect all these crazy ideas. I didn't make this stuff up. It's just 40 years doing this stuff. Like I'm
Yeah.
brain rot. I remember
Of
all this
course.
stuff.
Of course.
No, but it's like Andrew Smithers, one of the brightest men I've ever met. He was strategist for S.G. Warburg back in the day, predecessor firm to Warburg Securities, predecessor firm to ultimately became UBS.
Yeah.
Um, he said, I'll say this twice because without action, there's crisis.
Mm.
Without crisis, you will not have any action. Therefore, since there's no action, you're going to have a crisis. It's circular.
Yeah.
So it's kind of like, Dave, I think we all appreciate it. I mean, MMT's for the birds. Okay, you just can't keep spending more and more money with no consequence. All right.
Yeah.
But the thing is, if both the Democrats and Republicans say, let's spend more, and they can keep running bigger and bigger deficits, and the bond market doesn't revolt, it's like in basketball, David. You'll keep running the same damn play
Yeah.
until the defense stops you. All right.
100%.
So I think that's what we're looking at here. And so it's not about inflation necessarily, because the true inflation thing is actually it's only down to 1.6% in the MIT study of 5,000 prices and blah blah blah. My inflation number is lower than yours. It's not what this is about.
Yeah.
This is about real interest rates and demand for capital. And I also happen to think inflation is going up. Good thing oil prices might not look like they're bottom end of the charts. Otherwise, I might really get worried, right?
Yeah.
So that's kind of where, if you ask me, like, why am I cautious?
Yeah.
It's largely for those reasons. And, markets can price risk. They're good at pricing risk, but they can't deal with uncertainty.
Yeah.
And it's become a national pastime to try to figure out what's going to happen with tariffs. Nobody knows. Trump doesn't even know. He changes his mind every other day. Gets on a political statement, right? And most importantly, as I said before, remember from the whole Zelensky thing with Trump in the White House, you don't hold the cards. I hold all the cards.
Yeah.
Well, Donald, I got news for you. You don't hold the cards. Mr. Market holds all the cards. So, it's a national sport. Simon says tariffs, no tariffs, this, that, whatever. Okay. And so when you talk about this uncertainty, not about risk, uncertainty. Okay. Nobody knows. And there's a line from the great Hollywood guy. I forget, William Goldman, I think. And I use this all the time. This one I did. Nobody knows nothing. Like people don't know. Nobody
It's
knows.
true. It's
Hey,
true.
sorry, man.
So George, then the most important question, arguably, right? How do you navigate? How do you position yourself through this kind of period, right? If and I totally agree, right? I mean, you have the dollar weakening. I mean, non-U.S. markets thriving while U.S. markets have not done so. It certainly feels like at least some big cohort of non-U.S. investors are not aggressively throwing money at the U.S. markets. I think that's going to be one of those ripple effect. That's going to be something that probably hinders gains in the U.S. down the road. But for now, you have semiconductors doing well. You even have oil companies starting to break out. So
Hmm.
so how do you position yourself in a period like this where uncertainty is so high, but we
Right.
have to be somewhere? Like, how do you navigate through this kind of period?
So I think along two different tracks.
Yep.
If you're a domestic investor, it has and you would see this in the charts, David. I'll turn around with it as a question. It's got definite sectoral and factor implications.
Mm,
Okay, so companies with poor balance sheets, negative cash flow, um, exposed to rising input costs because of a falling dollar, et cetera, et cetera. Et cetera is paribus. Those stocks aren't going to do as well.
yeah.
Okay. But I don't want to say inflation plays, but some of the metal stocks, gold stocks without question, gold, precious metals, gold and gold stocks without question,
Yeah.
by far and away is my favorite.
Yep.
As Michael Howell said the other day, people are pursuing monetary hedges, monetary inflation hedges, not inflation hedges, because it's not necessarily the case that, as he would say, as a Brit would say, high street inflation is going to go up.
Yeah.
But monetary inflation is with us and is going to accelerate because they're printing more and more money. So people buy gold and precious metals as much as a store of value as anything else because they can't print more gold.
Yeah.
And for all the Bitcoin people out there, the same thing could be said probably for Bitcoin. Although one concern I have about Bitcoin is, yeah, it's correlated to the price to the dollar and liquidity and gold, but it's also still behaves kind of like a risk asset. And
Yep.
we see that when the market sells off, Bitcoin doesn't do so well. So if you're optimistic about risk assets, okay. But if you say, hey George, you know what? I think you're right. Dollar's going to go down. I don't want to own those depreciating pieces of green paper in my pocket. I want to store value. I'll buy gold. I'll buy some Bitcoin. The Bitcoin may work, but if we get a bear market, a big decline in risk assets, not so much. And we saw what happened. I mean, Bitcoin's, I think, at a new closing high now, roughly speaking. Okay,
Yeah.
but it gets these big corrections every once in a while.
For
So
sure.
to me, gold is maybe it doesn't offer the upside. The beta to liquidity is not as great as it is for Bitcoin, but I don't. I think the downside is much more muted. So you asked what should people do domestically? I think it has sector implications. As you and I both know, David, it's a market of stocks.
Yep.
So probably some of the. I mean, Jordy Visser, another great speaker, was talking on Bitcoin and AI. And I think the next real play on AI, like I don't have a real strong opinion on the video, but to me, what's more interesting is the beneficiaries of AI, like use cases. So, it was brought up if you can find, a healthcare company that by using AI they can increase their efficiency and get rid of 20% of their overhead. Like that would be a huge thing. So I think he used example in McKesson. It was Adam Parker.
Hmm.
He's like, it's a company, it's a distributor. They only have like a 2 or 3% margin. It's a low margin business. But if the margins can go from 2 to 2.5% because they get rid of 20% of the white collar workers, it's a huge earnings increase in a big
Yeah.
stock, right? So
Yep.
I think the AI beneficiaries, the AI use cases, doesn't mean Nvidia. It means the guys who are buying the Nvidia stuff. Okay,
Right.
but then more importantly, the bigger thing, I think, with the down dollar and limited scope for fiscal expansion here, and also because we still have some inflationary pressures, limited scope for rate cuts. I don't want to get into the game. They're going to cut rates one time, 5 times. What do I know? Okay, but my best guess is they're going to cut rates less than people imagine. It wouldn't surprise me if there are no rate cuts this year
Yeah. Right.
because, stories of a recession have been greatly exaggerated. Maybe it's going to happen. Maybe it won't. What do I know? It's like waiting for Godot. But there's less scope for monetary ease here, and
Yeah.
there's less scope for fiscal ease. And now in Europe, we all read a few weeks ago where they released the debt brake and they're going to spend a lot on defense, all this sort of stuff. So the first time in a long time, you're seeing big fiscal expansion in Europe. You're also seeing in Asia. and also because the inflation picture is much more subdued than it is here, they are in a much better position to cut rates, or they don't have to raise rates. Excuse me, they don't have to raise rates as much as the U.S. will. So
Right.
you take more favorable macro situation abroad with much cheaper valuations, with positioning, which David, getting back to the IQ contest again, it's where are people on the chessboard, okay?
Yeah.
There's been no reason to invest abroad the last umpteen years, all right? I like to joke, if I can lose money between 9:30 a.m. and 4 p.m. Eastern time, why do I have to be up at night watching the Japanese market, okay, or get up first thing in the morning, all right? And so what's happened here, U.S. investors have not put money abroad for the most part.
Yep.
And the foreign investors, they've been piling in here because this is like the greatest story ever told, U.S. exceptionalism.
Yeah.
Well, again, U.S. exceptionalism. You know what's truly exceptional about the U.S., David? Yeah, we got great companies and Amazon and Microsoft and they're unique and they got moats and cash flow. That's all true. But there's another part of U.S. exceptionalism that people, I think, forget or they overlook, and that is no one runs bigger deficits than we do. That's what's really exceptional. Okay, and so what that means is if Mr. Market is starting to say no more money for you, we're gonna raise the interest rate, you have to pay for it, so we can't spend as much. And I'll remind you, fiscal expansion. The more we spend, the public sector deficit is the private sector surplus. We spend more money, companies make more money.
Yeah.
We spend less money, companies make less money. So I think there are constraints now on our fiscal thing. And so tying this all up, though, I think to me, giving you the macro nonsense conclusion, I think it's pretty clear they want to run things hot.
Yeah.
As we know, when you have a debt problem, there's two ways you can get out of that. One is you default in the debt. That's not going to happen.
Right.
Or two, you deflate the debt. You just have inflation. Debt's nominal. It just stays there, and the value of that debt goes down. So it's pretty clear that they're going for door number two.
Yeah.
And to me, that means, we don't have tight. We've got very loose money in this situation in this country, as far as I'm concerned.
Yep.
And so to me, that means lower dollar. Bond yields keep going up because the dollar's not holding its store of value. Someone asked the other day, what would make you become like not so bullish on gold or whatever? I said, well, if we had responsible fiscal policy in this country, that's not going to happen.
Yep.
Or if we had interest rates at a level that were appropriate, which they're not, they're way too low.
Sure.
So, David, you heard the line about, gold. It's same as Bitcoin. They'll say, well, it's an asset which isn't somebody else's liability. All right. So you're outside the fiat money system. All right. So they can print more and more money, but they can't print more gold and they can't print more Bitcoin. All right. So that's the difference. So I think and here's the last thing I'll say to you on this as well. Think about this for a second, David. The next time we're on, I'm gonna demand that you come with charts. So people say, actually, you should put this up on the thing later on at the end.
Yeah.
People say, wow, look at the S&P, it's up, blah, blah, blah. David, that's because you're counting in American pesos, okay? If I said to you, measure the S&P divided by Turkish lira, it'd be like up 10x, okay? All right, okay? Back in the day, and here we go to the charts, okay? You used to say, look at Argentine pesos, right? Okay?
Right.
So any stock market in the world measured in in Turkish lira has gone to the moon.
Sure.
Okay,
Sure.
so it's all money illusion.
Yeah, and if you and to be clear, if you look at the S&P in gold terms or in any real asset, right?
Yes,
totally different chart, right? Completely different.
Yeah, and you know what's shocking? I know you know this, David, because I think I actually read some of your stuff. Gold, the S&P in gold terms, I think you have the chart up there right now. Go a little bit longer back, okay? It hasn't made it's down over the last 3 or 4, or flat in the last 3 or 4 years, okay? Yeah. And then actually, this is a shocker. I think since 2020 or 2021, despite the bull market we've had, given the recent rally in gold has actually outperformed the S&P since like 2001 or something like that. It's crazy. So it's all money illusion. It's phony. It's as John Roque would say, our favorite technician. It's a fugazi. It's fake.
George, so many great points in here, and I hope that whets all of our listeners' appetites for you to come back again to keep this conversation, because you're 100% right, and I think your description of where we're at in terms of liquidity, where we're at in terms of the interest rate environment, the difference between nominal terms and real terms. And to bring it back to Fidelity, one of my favorite charts in the chart room was I think it was the S&P in nominal terms, and then behind it was the S&P in real terms. And I always pointed out the 1970s, great sideways period. It took 16, 17 years to make a new high again. But in real terms, you were getting absolutely crushed. And it's so hard for investors to separate the nominal terms were reported and the real experience of what it means for our portfolio. George, this was awesome. I can't thank you enough for coming on the show. I hope we can do it again, and I really appreciate your conference that you put on. I hope you can continue that in the future. But congrats.
Right, I have to do it again. And thank you, Dave, very much. And I was just getting started. We haven't gotten out of the first inning yet, so
episode 2, we'll have a lot more time for sure. Thanks again, George.
Thanks, David. Yep.
It's a fun conversation. I tell you what, George was incredibly restrained there. The moment we, before we hit record and when we stopped, he's an intense guy. He's all over the place in a very good way. George is just an encyclopedia of market history. I mean, being able to ask someone like George Noble lessons learned through his career is just a real pleasure. And I love so many things that he talked about. He may be the only person I've interviewed that I can remember that talked about that Bennett Goodspeed book, The Dow Jones Averages. I'll put a link in the description or in the comments so you can check that book out. It is on my recommended reading list at marketmisbehavior.com, although very few know about it. And I feel like I learned about it at Fidelity, and I wouldn't be surprised if it was someone that George had referred to the book, and then I saw it sitting on their desk. That's how books tended to, promulgate around the firm. But it talks really about whole-brained investing, about the importance of left-brain, detail-oriented work, analyzing companies and in particular investment opportunities. But also as a portfolio manager, you really need to see the big picture. You need to be more of a right-brained, creative investor, thinking about relationships and longer-term trends and shifts, and not get so caught up in the nitty-gritty and the weeds that you forget to recognize the climate or the overall environment is changing. So, great book reco there, and some fantastic anecdotes for sure about going through his investment career. Specifically, really appreciate his comments toward the end about the S&P, about stocks in terms of real terms, right? In terms of real assets. And so one of the ways you can do that is do a ratio of the S&P to gold. I'll include a link to a chart that tells that story. If you look at the S&P 500 in nominal terms, we're sort of at or near new all-time highs here in 2024 and 2025. If you look at the S&P in real terms and just look at it in the terms of gold, for example, we're nowhere near new all-time highs. And what I've often told people is the S&P in nominal terms is what the index is doing. The S&P in terms of hard assets, in terms of gold, that's what it actually feels like. If you're wondering why the bull market in 2024 felt like a very hated bull market, like no one sort of felt as good as we should have, given the rally in risk assets, it's because in real terms, it just really wasn't that great of a year. So some really thoughtful comments there all along the way, and some great stories from George Noble. Thanks as always to George for coming on the show. And again, hope we can return the favor, maybe do his spaces at some point as well. As a reminder, if the discussions that we had about particular charts, and we didn't get too charty in this particular episode, but George and I have often talked about particular charts, about macro and micro themes, about leadership rotation, about breadth and sentiment and momentum. And if you want to learn more about those tools and techniques we both use to better understand the world around us as investors, our Market Misbehavior Premium memberships may be a great way for you to upgrade your own mastery of those particular tools and techniques. 3 great benefits to the premium membership. First off, you'll have access to all of our virtual courses. We'll start with Flight School Behavioral Investing. George Noble today talked about some of the challenges you face, behavioral challenges, how you manage those, having humility. We'll talk about what happens between your ears as an investor. And then we'll talk about technical analysis, a practical set of tools to address some of those behavioral challenges in your process. Second benefit of the premium membership, you will have access to our members-only reports, our weekly flight plan, where we really look every weekend at the week that just happened. What did we learn? What was new? What was different? And then focus on the week to come. What levels, patterns, signals are we watching for? Also, our monthly chart review, where we apply our proprietary market trend model to a series of ETFs and asset classes. Finally, you'll have full and immediate access to our members-only community. That is a supportive group of like-minded investors where you can ask questions, you can learn from others' journey through the investing process, and have a great place to ask questions and get them answered by me and the community. For more information about our premium memberships, go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. Who should we have on the podcast? Who else should we sit down with to ask questions, to learn from their expertise, and to get some perspective on the current market environment? Wherever you're listening to this, make sure you drop a comment and let me know. Always looking for some good potential guests for the podcast. For Market Misbehavior, I'm Dave Keller. Have a great one, and remember, it's always a good time to own good charts.